Okay, time to get started. In this module, we're going to talk about how to handle the money. And the result of this is you'll be able to handle the money, manage it with less stress so that you can focus on the things which matter the most, namely the mission of your business or your nonprofit. Now, before I get started into this, and it's going to be a screen share, so you're going to be able to see it right there and just follow along. You could download the slides, those are linked down below as well. You may want to just print those and then just take whatever notes you're going to take right on top of those slides. If you're working with a team, whether it's in a business or working with a team in a nonprofit, a ministry, or even a church, feel free to take those slides and pass those out to others on your team as well. I will say this from the outset. In this training, we are going to talk about really how to manage the finances in a for-profit organization. So that's a business. So many people that come to us are leading coaching organizations, or they're trying to platform a message in the form of a book, in the form of a course, in the form of doing events or retreats or workshops, or all of the above. So they're really running a business. And at this point, it may be a new business or they may be a solopreneur. Others are coming to us from the nonprofit standpoint. So they are running a 501c3, they are running a ministry, some of them are running a church. And the reason I'm including all of this in one module is because increasingly it seems that more and more people are coming to us who actually straddle the fence and do both. They may have a parallel nonprofit running next to a business, or they may have a business running next to a nonprofit, or they may be doing business and then at some point say, hey, it would really be beneficial if I did the nonprofit thing because then I could apply for some grants, I could handle money in a different way. And so increasingly, we see people doing both. I see a lot of pastors come to us and they want, so they're number two right there on the screen, nonprofit, and they want help launching a book. Well, the book's going to turn a profit, so that's going to be a number one. Or it just, there's so many different ways it could go here. And the truth is, running a nonprofit on the financial side and on the organizational side, it's not as dissimilar from a business as you might think. And so some of this will apply to some of the people watching, some of this will apply to other people who are watching, but all of this is going to have some common threads that are going to um, I just think it's going to hit. All right, so let's get into it. So handling the money, how to manage the money with less stress so you can focus on the things that matter the most. Uh, this is a companion module, just so you know, where we talk about building a business plan to grow. So if you have not watched that module, this one will stand alone on its own. However, there is a whole nother module where you can actually chart income and you can figure out, okay, what is the growth cycle and how do we, generate leads and how many products do we have to sell? Now, that primarily relates to business. But again, even on the nonprofit side right now, we're doing some things with the nonprofit. I'm working on a nonprofit with my dad right now. We're even looking at some of the things from a business standpoint. It's a lot easier to do foreign mission trips and go work with 100 pastors in another country and resource them and equip them when the business side is in order. And you're not stressing about how are we going to resource them. Man, it's a lot easier to network with other ministry leaders across the state and the region when you're not stressed about the money, when there is a plan in place that you can follow. It's just good stewardship. It's just good wisdom. Okay, so why does this module matter? Here's a few points for you. The first step there, it's difficult to focus on the mission when you're worried about the money. So if you're stressing about finances and wondering how to manage the cash flow, this module is going to help you know how to handle the money so that you can focus on the mission. Now, here's what this module is not going to do. It's not going to tell you where to find the money. We've got some other resources that I'll point you to along the way. This module is going to tell you, all right, what do you do once you get it? And what's the plan that you need to set in place now so that you can manage it well? You can hang on to what you need to hang on to. You can set aside for the needs that you have coming up, like taxes and future opportunities. And the reality, just kind of that bottom paragraph on the screen there, whether you embrace this topic or avoid it, and so many people just avoid it. So many people avoid it, especially content creators and communicators and ministry people, which is who we mainly deal with. If you're a content creator, you avoid it really because your call, you're more intrigued by delivering the message. If you're in ministry, your call, you're more propelled to focus on the people and making an impact. And so it's easy to overlook this. So it doesn't mean you're a bad person. It's not, it doesn't mean you're negative. That's why you get a team around you, because their call is as much as yours is to get a message out or to impact people. Their call is as much as that is to you. It is to them to manage the resources, to steward them. But still, if you're leading that organization, you've got to take a proactive approach so that money can enhance and serve that mission, not get tangled up. Okay, overview of the module. Here's what we're going to do. I've broken it down into 3 parts. There's timestamps down below. So if you want to skip around or if you want to review and come back, easy to do. First part, we're going to talk about what to do in for-profit organizations. The second part, we're going to talk about what do you do if you are a nonprofit or a ministry or a church, a 501c3, any of that. It's all going to be the same. And you're going to find a lot of parallels right there between the nonprofits, again, and the business. So that's when we're going to start with business. And then third of all, we are going to dialogue about 4 common threads that are the same, regardless of whether it's for-profit or not for profit. Again, pro tip. You've got to deal with the topic of money. Whether you embrace it or avoid it, you still need to address it. It's going to pop up, whether or not you take a proactive approach. So the pro tip, it's easier just to get ahead of it and to have a plan. And the result of this training, again, and it seems like I'm just kind of saying it over and over, but I want to emphasize, go ahead. If you're one that typically avoids this topic, take a deep breath and just realize, hey, the goal of this is so that you can focus on your mission and stress less, just knowing that all the money side is taken care of. That's the result of this training. Okay, part number 1 of 3, for-profit organizations. What do you do if you are a for-profit organization? Or let's just write this in here in real time. What do you do if you are a business, if you are a solopreneur, you're an entrepreneur? Here's what you do. Each of these modules has 3 sections. So 3 modules with 3 sections in these first 2. Number 1 of 3, you need 5 checking accounts if you're a business. Now, each checking account has a different purpose. Let me tell you the 5, and then we're going to walk through them. And I'm going to tell you exactly what to do with these 5. So 5 checking accounts. Step number 1 is you need 5 checking accounts. 5. Okay, you need a business operating account. You need a personal checking account. I'm going to talk about that one a little bit more in a second. You need a business savings account. That's number 3. Number 4, you need a business tax account. Number 5, you need a business investment account. Now, let me say right here, that one that I've circled on the screen, the personal checking account, it's not a business account. It is your account with your money that is completely separate from the money that's flowing into and through your business. Now, I'm going to dialogue a little bit more about it in a second, but I'm saying it right here because so many times we meet with, especially in the space that we're dealing with, where you've got content creators and communicators that are launching new ideas and just starting to get this thing rolling. They mix the business money with their personal money, and that is a massive mistake that you need to set in order on the front end. And if you already have been rolling, you just need to correct it as soon as you can. Okay. So all these accounts, 4 business accounts and a personal account. You probably already have that personal account. You need to keep everything separate from the business and from what you've got going on with you personally. So, a note, other than number 2, the personal checking account, all of these can be, emphasize can be, sub accounts of a single bank account if your bank facilitates it. But they need to be separate so that you can keep the money divided into unique buckets. Now, in a minute, I'm going to explain why that's important. Here is what I'm saying for clarity, though. You need 4 different business checking accounts. Number 5 right there is actually the second one on the list. That's your personal checking account. So to run a business in a healthy way, you need 5 accounts. They need to all be separate unless, and this is a major unless, the bank you work with, and we found one that we use that's an online bank. They don't even have branches. You can subdivide one account into separate sub accounts. And so I know that there are some banks that do that. Here's what that means. If you have, let's just use a round number. If you have $40,000 in your business checking account in that bank, that means that we can separate all of these others up here. We could have 10,000 in the operating. We could have 10,000 in the savings. We could have 10,000 in the tax. We could have 10,000 in the investment. Now we've got to keep all of that separate, because what we don't want to happen is just have it all in one pot and then it comes time to pay taxes and we don't have it. And so now we're behind and we've got to go to Uncle Sam and get on a payment plan and pay a worse rate of interest than you would pay the mob or a loan shark or something like that. So it's got to be completely separate. So if your bank facilitates it, great. If they don't just assume that you can keep track of this in QuickBooks and that everybody will be on track. I mean, you need a firewall between these different accounts. Okay, so you got to set up the 5 if you're running a business, just realizing, okay, 4 of these are the business accounts, and one of them, number 2 on the list, is my personal checking account that has nothing to do with the business. It is money that is staying separate, no matter if that business is doing 5 million or 10 million a year, or if that business has just started and I'm hoping the business does $50,000 or $100,000 this year. You got to keep the money separate. I think there's like an old 80s or 90s song that's going through my head about that right now. You got to keep it separated. Number 2 of 3. Here's how to use the accounts. You want to use the accounts in the following manner for it says church right here. No, that's not right. Using the following manner for a business. Okay, you can tell I always use templates and then kind of cut and paste. So you want to use the accounts in the following manner for a business. Here's how we're going to use account number 1. The business operating account. All the money for the organization flows in and out of this account. It can't be mixed with personal money. Can't be mixed with personal bills. You don't pay your power bill out of the business operating account. You don't pay your car out of the business operating account. You don't pay your credit card out of the business operating account, even if you bought something for the business. That's, again, if you choose to use a business credit card, you got to make sure it's a business credit card that only pays for business expenses, that it's paid in full each month. I used to pay mine weekly just so it didn't pile up. Now my wife handles our business finances, and so I don't have to do it. So she uses the rhythm that works for her. But the business operating account, everything that flows into and through the business goes into this account. What does that mean? If you sell something, it goes into this account. What does that mean? Somebody buys something online, it goes into this account. What does that mean? If you go speak somewhere, it goes into this account. What does that mean? If you do a workshop or have recurring memberships, or you have subscriptions that people are paying you for, it all goes into this account. And again, do not mix personal money with business money. You need to run that business with a budget. as you do your personal finances, and you need to stay in line with the budget. Now, I want you to notice there at the bottom, every month, here's one thing you need to do out of this account. Every month, you need to take 20% of the income and you need to place it in the business tax account. That's fourth on our list of bank accounts. And that should be also reflected in that budget. So you know that every $10,000 you get in, hey, two of that 10, boom, it's gone. You take it off the top. And so you're paying bills and you're doing salaries and you're doing other stuff that you got to do, software fees, everything else is coming out of that, not 10 in that case, it's coming out of that 8 in that case. And I know some of you that are watching this, you're doing a lot bigger numbers than that. Some of you are trying to get to that number. I'm just using round numbers. So don't be overwhelmed by the numbers. Don't be underwhelmed by the numbers. Just using round numbers because it's easy for us to kind of see how that works and how that operates. Okay. So again, here's the accounts. Everything is flowing into that business operating account. Everything. Not paying any bills out of your personal checking account, not paying your personal stuff out of the business account. It is a business account. And we want to take 20% off and put it in that business tax account. Okay, that's how that thing is running. Common question. Does this account reflect my budget? Yes. This account, it's the starting point. Your budget should be reflected here. Every other account is going to flow really kind of downhill from this one. And so even if it's money that we're going to keep, even if it's money that we're going to use for something else, even if it's money that we're going to save for future use, even if it's money that we're just going to hold for a tax payment, all of it is coming into that business operating account. Here's the second account you need. You need a personal checking account. Now, this is not in the name of your business, nor is the business account. That's a completely different designation at the bank. Like you got to go in and to get that business account, you got to put it in the name of your company. It is going to have what's called an EIN, an employee identification number. That is kind of the equivalent of a social security number for a business. Nonprofits actually have EIN numbers. Churches actually have EIN numbers. So to set up a business, you've got to, be recognized by the state. It's an easy paperwork to fill out, and you got to have that EIN number. And so getting recognized by the state does reserve the technical legal designation of your name. And then you get that EIN number from the IRS, and that EIN number is put in the name that is recognized from the state. And so then you're kind of going both directions right there. You've got both the state and the federal kind of covered all in one. Now, this personal checking account, that's got to be in your name with your social security number. And I'm saying it right here and putting it into training about business because this is going to be where you deposit your salary. So let's just use that $10,000 example. If every month the business is bringing in 10, you go, well, 2's going to that business tax account. Let's just say your salary's 5 of it. Well, so every month, 5 is got to go somehow to that personal checking account. You could divide it up. You could do it every month. You could do it every 2 weeks. You could do whatever pay schedule you create. You pay yourself a salary. The best way to do this, in my opinion, is to run it through payroll as soon as you can do that, because the business has taxes. Personally, you got some taxes and you got to set some stuff aside, unless you're disciplined to take that 5 and then start separating it off. But you got FICA and all this kind of stuff. And so by running it through a payroll company, it does give you the benefit of really being able to let the payroll company handle what's the FICA, what's the income tax for you personally, how are you going to get the W-2s at the end of the year, all these things. And then it gives you at the business one budget line item that's the pulling it out of the business account to go into your personal checking account. And it kind of takes a whole other layer of bookkeeping off of you and a whole nother layer of liability and responsibility. And it places all on that payroll company. And payroll companies really don't charge that much. It may cost, 20, $25 to do this per check. Well, if you're just paying yourself once a month and managing the cash flow, goodness, that's worth that 25 bucks. I mean, it's worth the hours that it would take you or anybody on your team to do. And it's worth having that liability removed from you so that you know that it's done right. So if anything ever comes back, there are people who are professionals that do this all the time. I mean, you don't even change your own oil in your car, most likely. So why would you take on the responsibility if you're not taking on the responsibility for your air and your antifreeze and your coolant and all that in your car? Why would you take on the responsibility for all this financial stuff that is so much more tangly and has all these big legal ramifications and all that? It's a whole different level there. Just shift the way you think about it a little bit. Now, again, your personal checking account, it is different, and then it is owned by you. It is in your name with your social security number, not the EIN of the organization, but I'm placing it here in this training to emphasize it is separate from the normal business flow. Okay. And emphasizing because you see it all the time, all the time. And honestly, I've done it myself where you get that business stuff mixed with the personal stuff. And then it's, oh man, it just creates a bookkeeping nightmare later on. And then it's just set it up right on the front end. Okay. Account number three. Account number three that you need is the business savings account. When your operating account, that was account number one, has enough to cover the bills for a full month before the month begins, here's what you need to do. Start splitting the difference between here and the tax account. Okay, so here's what that means. I'm going to give you an example in a second. It means that we're not going to keep everything that comes in forever in that operating account. We're going to hold enough in the operating account to run the business, and we're ongoing, we're pulling out our taxes, right? But as the business grows, we're going to assume the income is going to outpace our expenses in the business. And so we're going to start putting some money here. Let me just make it very practical. So if it requires, let's just say $15,000 a month to run your business, and that includes your salary. When the business operating account consistently has the full $15,000 at the beginning of the month on the first, before any sales are made. So you go, okay, let's just make up a date. It is March the 1st. And on March the 1st, we already have in the account all the money we need to run everything for the whole month. Man, that's great. It's like sigh of relief, right? Because so often, oh man, we got to have the sale so we can get everything paid. But man, when you get to that point, start splitting the income differential between this account and the tax account. So with $15,000 as your expenses, that means this month in March, if $25,000 in revenue rolls in, then that means we just keep $15,000 in the tank for the 1st of April. So we can run the business again the next month. But it means that what we get to do is we go ahead and place extra money in the tax account in addition to what we've already placed there. And so I know that account's getting really, really big. We don't want anything to come by surprise. And we're going to place $5,000 into this business savings account. Make sense? Now, the goal for the business savings account is to create a holding tank of 6 months of expenses. So what I'm saying is if it requires $15,000 to run our business each month, $15,000, then in this account, we want to get to the point to where we have amassed $90,000 in this account based on it requires $15,000 to run the business per month times 6 months, $90,000 goal in the business savings account, meaning if we didn't sell another thing for 6 months, and really you might even go, well, really for 7, because we're starting off the month with a full tank of gas, right? you think about the less stress. Now, this isn't money to go, oh, we need a new flat screen TV. No, no, no. You need to do that stuff out of your budget. This isn't money to go, oh, we need it. No, you need to build that stuff in your budget. This is so that you can always run the business. This is so that when something happens and something breaks that you weren't expecting, or man, there's an incredible opportunity for you to jump on, or it's a slow month, or it's just whatever comes your way, you can handle it. Now, common question is do I just put money here forever? Like 6 months, 9 months, whatever. Here's what I would suggest. After you have 6 months in this account, you can stop placing money in this account and then forward whatever would go in here into a business investment account. So what does that mean? That means every single month, if we are still doing $25,000, but it requires $15,000. So go back to the example before. If we're doing $25,000 a month, but it only requires $15,000 to run the business, 5,000 is going to go into the tax account. But once that business savings account has that $90,000, all of that can go into the business investment account. We just need to be sure that as we're doing this, we're going to talk about the business investment account in a moment. We just need to be sure that as we're doing this, we replace anything we take out of this account. So if there's an emergency and we take care of it, let's just say the great van that has a surround sound that you do block parties for your business. Okay, just made that up. I don't know why you would even have that, but you could. Let's just say somebody T-bones it, and then you got to fix all this stuff and whatever, and insurance covered some, but some it didn't, or whatever you got to do. So you take money out and you fix it, and then the insurance money comes in or whatever. As soon as you have more money, you replace the money to get back to the 6 months of holding before you continue going to the business investment account, which is number 5 on the list. Okay, let me back up. Business tax account. I've referred to this one a few times because we put 20% of all income off the top on it. And then as we start having overages from operating, we're continuing to grow this one. What we want to do from here is pay all quarterly tax bills on time from this account. This is going to ensure you never fall behind. It's going to ensure you never stress about a tax bill again. And here's what I would suggest. If you consistently have a cushion here, and because it's amassing, it's growing. We're putting that extra overage. We're splitting the overage that we've talked about. As you have that, consult your CPA before moving anything down to account number 5. So I'm not saying that it's got to stay in that tax account forever. What I am saying, to be clear, is before it goes farther, you need to have that conversation with a CPA. And I do suggest that you have a CPA, that you have a bookkeeper that looks at the stuff, that's helping you file your taxes every year for the business and for you personally. As you start growing, don't take that liability on yourself. Get a professional involved, and the same that you get a professional involved to help advise you on other things. Go ahead and get somebody in there. They're going to be more efficient. It's going to be a better use of your time to go earn income in your business for the business, and then also not have that liability, and at the same time, make sure it's being done extremely well. So again, right here, just going to highlight it. You don't have to keep this cushion going forever at an increasing rate. You do need to run it how everything above I've said applies. But once you pay, you got the taxes, and you keep having a buffer. At that point, you just let them know, hey, this thing continues to grow. Can you give me some advice? Should I continue letting it grow? Or, do I have the option now, instead of splitting money between the tax account and splitting money between the business savings or business investment? Could I just put it all in the savings or investment? Okay. And what we're doing there, we're pulling that 20% for taxes. And by doing that extra, we're just saying, hey, we do realize at some point we could throw ourselves into another tax bracket. And so that's the reason we keep increasing this account. And that's the reason you want to get a CPA's advice on it. Account number 5 is the business investment account. So this account might be a money market. It could be something else. In fact, you could use a money market for the tax account. It's just got to be something that you can draw money out of without a penalty. So the business investment account, it too could be a money market, could be something else which offers a better yield than just checking. One of the reasons we use an online checking account is because it pays us interest at probably 5 or 6 times the amount of interest that you could get in a little bank here down the street because they don't have as much overhead. Now, you see there kind of in the middle, it's not really a paragraph, it's just kind of a sentence. Your business, I really think, exists for this account number 5, to grow. So if you think about the perspective of your business, it's not just for currently living your mission. It's not just for currently paying your bills. It's certainly not just to pay taxes. It really exists to flow that money from the operating account, number 1, pull some money out of that to your checking account on your form of your salary only. That's number 2. To number 3 was the business savings account. That's where we want to get up 6 months of runway for the business so it can continue operating, even if it's a lean month or even if an emergency happens, something like that. Of course, we've got account number 4, which is for our taxes. Number 5, this is the one we want to grow long term. This is the one that you can use to build wealth. Let's talk a little bit about why and even how. Let me give you some vision for the business investment account. This is number 5. Annually, if you're doing a 5 to 7% return, annually, every $100,000 that you get all the way down to this account. And again, to get it to this account, you've already got to pay taxes or set the tax money aside. You already have needed to be sure you've got a runway for the business. So by the time it gets here, like, this is clear money. So every $100,000 that you've got in this account, it generates $5,000 to $7,000 a year, meaning every $500,000 generates $25,000 to $35,000, meaning every million that you have, you can just keep doing the math, generates every year $50,000 to $70,000, somewhere in that. At some point, this can become a cash machine that continues churning out capital for you if you do it correct. That means, pro tip, what you want to do if you're running a business and you own this business is you want to buy your personal assets from this account. You've already paid taxes on the income. You remember you set it aside to account number 4 up above, and we set it aside at an increasing rate so that we were never taken by surprise. Oh, but when we purchase those assets, we want to do so from the interest income in here so that the corpus doesn't shrink. So if, let's just say we've got $100,000 in here, and that 100,000 is, really benefiting us $5,000 to $7,000 a month, a year. I'm sorry. Or we have $500,000 in here, and it's generating, as I have on the screen, 25 to 35,000. Or you have $1 million in this account, and it's generating $50,000 to $70,000 a year. We want to buy assets out of that interest so that that 100,000, the 500,000, or the million stays and continues generating and growing more interest at an increasing rate. You can think about it like this. If you have $100,000 in that account and just continue letting it grow, at some point, got 500,000, $25,000 right there, you could go buy something for $25,000. If you buy it out of the corpus, if you buy it out of that 500,000, you drop it, you've just dropped the amount of interest it's going to earn. But if you buy an asset out of the interest next year, it will continue replacing. Here's what I mean. You could go buy. I would not buy this. You could go buy a Mini Cooper or a Jeep for $25,000. You'd have to be a used one of either, but you could go buy that and diminish the corpus of your bank account, and you could be out, or you could go buy it out of your personal savings and be out. But if you bought it from the interest, you could buy that same car. You could buy a new one or a used one, nice used one. Every single year, you could get a new Mini Cooper. Every single year, you could get a new Jeep. Again, not saying that would be a great purchase at all. It's just to give you a little vision. Now, as you do this, you really need to understand what assets are and what liabilities are. Cars, boats, even though everybody tallies them up on their net worth on their spreadsheet, those usually are not assets. Even if you own it outright, you're not making a payment on it. It's not really an asset. CDs, real estate, even businesses that you have a stake in, that you own other businesses, those are generally are assets. Assets create money for you. Liabilities take money from you. So a really nice bass boat is not an asset, it's a liability. A really nice RV, not really an asset. As we're thinking about assets right here, it's a liability. Some real estate, it actually could be an asset. So again, plain talk. Instead of purchasing a $30,000 car from your savings once every 5 years, you could in theory. And this is just to give you vision to show you how it works. You could buy a new one every single year from the interest income on a right-sized investment. Again, not that you want to make that purchase. It just shows you what's possible. Okay, let me show you what we've done so far. We've talked about for profit. Number one of three, you need 5 checking accounts. 4 of them are business accounts. Number 2, now you know how to use them and how to flow the money down from the first all the way through the others and what to do. Number 3 is you just need to work the process. So number 3 is, does this strategy take time? Absolutely. But once you set it in motion, it'll work much like a flywheel, and it will continue gaining that momentum. It will continue churning at a predictably faster pace. And as it's growing, you're paying off debt, which means more money can go towards the savings side and the asset side rather than going out the door to pay for past purchases. So as you move forward and you get better at sales and you get better at promotion and marketing and you get your voice and you find your lane, so it all gets easier. But at some point, like, yeah, everybody starts at pretty much ground zero. And then you just let it take the time it takes.